Welcome back, everybody. You know, high prices at the gas pump and the grocery store may be putting a hole in our wallets today, but inflation and high interest rates may also be affecting our future finances. So what can we do to protect our financial future? Well, here with some answers, our lead partner, Emmett G. Dupas, and associate partner, Dylan Hoon. They are with Bienville Capital Group. They are back on the show to talk about finances. Gentlemen, welcome back.
Great to be back in the studio.
Great to have you all here as well.
You.
Look at the ties. These men look great, and I am so glad we're talking about this, gentlemen. First, I want to talk about how, you know, it's been in the news a lot lately, inflation and, of course, rising interest rates. Emmett, tell us, how is that affecting our investments?
Well, I think first and foremost is the direct effect is in regards to the bond market, which is for consumers, that's generally the most conservative component of their investment allocation. And you know, what is a bond? And so bonds are issued by municipalities, they're issued by governments, they're issued by corporations. And so basically it is a loan that you are in $1,000 increments that you're applying, you invest in, and they send quarterly or semi-annual dividend payments or coupon payments to you, and they have direct effect in regards to what's transpiring with interest rates. And so that for a conservative investor, that's the most part of their portfolio that is most impacted in a higher inflation scenario.
It really is interesting because, you know, at the end of the day, you know, they are predictable. Why does the value of our bond investments change, Dylan, if they change at all?
So the cash flows from bonds are predictable. You know when you're going to get your interest payments, but the value of your bonds are not. So let's use an example. Let's say I give you a loan today at 3%.
Thank you.
Absolutely. A month from now, interest rates go up to 4%. So the value of my loan to you at 3% wouldn't be worth as much if I had given it to you at 4%. And this is kind of illustrates the key relationship between bonds. The value of your bond is inversely related to the interest rates. Think of it as a seesaw. You got interest rates here, value of your bonds here. As interest rates go up, they push the price of your bond down.
So how can we better protect our bonds? Because, you know, the market is so volatile right now. Inflation is down, then it's back up. What can we do to help our financial future?
Well, bonds serve kind of a key role in your portfolio, and that's usually to cushion it from any falls in the stock market. Stock market goes down, interest rates go down, bonds go up. They can also be used to manage your spending liabilities, and there's a lot of different types of bonds. There's high yield bonds, global bonds, treasuries, corporates, credit, etc. And they all kind of behave differently.
Is one better than the other?
No, they're all different. They behave differently depending on the economic circumstances. You combine them together in a diversified portfolio that kind of suits your needs and can help shield you from specific economic events.
And you know, since obviously we're still dealing with inflation right now, I want to talk about just in general, gentlemen. If people are watching right now and they're like, ooh, should I invest right now? From you all's professional opinion, should we invest in anything right now?
I think the answer to that is depending upon a particular person's situation. Everyone's got different investment objectives and risk tolerance. So the challenge is the risk tolerance with the market volatility. If this is really short-term money that's needed on a short-term basis, there are financial instruments that one could look at to look at their yields and what they're earning with less market volatility. If someone's got, you know, like yourself, what are you, 20 what now?
26, 27 in December. Happy birthday.
So we got 40 more years until your Social Security fully kicks in.
40 years, oh Lord.
So you've got more time on your side from a time horizon to be able to invest, because the market doesn't just go straight up. There are periods and peaks where you see the market goes sideways for some time, and you can look back at every period in history, and that's the fact.
And you know, since there are periods and peaks, right? If somebody already has bonds right now and they're like, ooh, I don't know what the market's gonna look like next week, let me go ahead and just sell my bonds. Dylan, what do you suggest? Do we sell them? Do we wait and see? What do you think?
You know, it really depends on your specific situation. Like, if you're gonna need the money right now, very soon, the next few months, yeah, you probably should sell. But it's really about meeting your specific objectives. We have all those different types of bonds. How we combine them together to meet your needs is really what we're talking about here. And you know, we think at that point, you should probably be working with a financial professional.
And you know, we're forecasting here, everybody. Obviously, it could look different tomorrow, but what does the market look like maybe as we go into the holidays? Do you think it's going to get a little bit better? Are we going to see interest rates hike up a little bit more? What do you all see? I know we're forecasting here, but what do you think?
I think the market expectation is for the Fed to raise interest rates next week. As to what that's going to be.
Again?
Yeah, that's the forecast.
And why are they doing that?
So you've got two components, monetary policy and fiscal policy. And so the Fed's trying to combat inflation by raising interest rates to slow down the economy.
Because when people see the high interest rates, they're going to be like, ooh, that's too high, I'm going to hold back.
It decreases spending, decreases the money supply. It just overall puts kind of brakes on the economy. So that can help kind of decrease inflation over the long term.
Ladies and gentlemen, more of the story, start saving now. Gentlemen, thank you so much for the conversation this morning. I definitely learned a lot. And look, if you all want more great information about investing, you can contact Bienville Capital Group. Log on to bienvillecapitalgroup.com or give them a call at 504-620-4801. They're located at 111 Veterans Boulevard, Suite 940. All right, stay right there, everybody. We'll be right back.